Welcome back to Elevate from Burnout to Bliss, the podcast where we explore fresh opportunities, financial freedom, and a life fueled by passion. I'm your host, Reggie.
And I'm Ebony.
And we're diving into some of the most pressing financial questions submitted by our listeners.
It is March and tax season is in full swing, and the stock market is experiencing some unusual ups and downs. So it's more important than ever to stay informed. In this episode, we'll break down the latest financial headlines, discuss market volatility, and tackle some key tax strategies to help you keep more of what you earn.
So whether you're navigating investment uncertainty, trying to maximize your tax refund, or just looking for solid financial guidance, this episode has you covered. So stay tuned as we answer your questions and help you take control of your financial future. All right, so let's go ahead and get into it. So y'all, this week, we decided to do something a little different, and we still got special guests lined up that we're going to bring in and give some great information about, how they was able to transform their life and all the good stuff that we talk about. But this week, we decided to put a pin in that because our office was inundated with calls of people who wanted answers to, what was happening in the market, implementation of tariffs, and just a number of things. So we decided that, hey, this is a great time to take a step back and give people all the answers, admitted that we can provide, answers that they're looking for. And, and we just hope that this will be beneficial. And, let's take it from there. So, Eb, if you don't mind, we just fire away at, the questions that we got and we'll answer them as we get to them.
Yeah, it was a lot going on this week. So like Reggie said, we know you all have a lot of questions, so we're going to answer the ones that we can. So our first question comes from Terrence Harrell, and he says, how might President Trump's proposed tariffs on imports from Canada, Mexico, and China impact the U.S. economy, particularly in terms of inflation and consumer prices?
Oh, wow. That's a lot to unpack right there.
It is.
And that's a great question, Terrence. I tell you what, let me take a step back before I answer that, because there's a lot of misinformation even about what a tariff is. Mm-hmm. And I want to get that part clear before I answer the rest of the question, or before I answer the question. So just so all the listeners know, a tariff is a tax on imported goods that's coming into the country. All right. So, some people they're kind of confused on that. So it's a tax on things that's being shipped into the United States.
And some people think that that's just for things that are manufactured outside of the U.S. and are shipped inside. But there are things that are manufactured inside the U.S., but some of the parts come from outside the country.
Absolutely.
So those would be hit with tariffs as well.
There you go. So domestic businesses, again, these are businesses inside the U.S. that import products into the country. That's who pays the taxes, or the tariffs, if you will. So a lot of times, I heard someone say, well, the government pays the tariff. That's not true, you all. The companies that are importing the good, the part, like Ed mentioned, or the completed product, they pay the tariff, all right? As a matter of fact, it's 328 points of entry into the United States. It's been designated.
That's interesting.
Yeah, it is, by the Customs and Border Protection. So it's 328 spots where stuff coming to the country. And this is where, including airports, railways, roads, and ports, this is where these agents collect the tariff from the domestic business based on, where the product is, what product it is, what country it originated from. And then that money is paid to the government.
But it's not the government paying the
No,
tariffs.
That's exactly right. That money is paid to the government by the business that had to pay to get their product over here.
So what do you think happens then? The companies are paying the tariffs,
right?
But who ultimately is paying the
Well,
tariffs?
and there's no doubt about it. So what ends up happening after then is, once these companies had to pay 25% more to get their product here, they pass it on to the consumers. They can't eat that. They can't eat all that.
I guarantee they're not going to eat.
No, they can't. That doesn't make sense. So they pass that on to the consumers, you and I, people that's out here purchasing whatever it is we want, whatever we need, in the form of higher prices. Mm-hmm. That's where it's ultimately. So now specifically, when you think about, okay, so what are we actually getting from China, from Mexico, I want to deal with Mexico and Canada first. Okay. Those are our neighbors. So before the U.S. began imposing 25% tariffs on goods from China and Mexico, as of last Tuesday or this past Tuesday, Most goods move between these three countries, what we call duty free,
Right.
tariff free. So there was a trade agreement in place that said, hey, we're gonna, products coming from Mexico up to U.S., up to Canada, vice versa, however they moving.
NAFTA.
NAFTA.
North American Free Trade Agreement.
There you go. Been in place for a long time. It allowed businesses to move products in and out without anybody hitting anybody else with a tariff. Okay. Well, now that's not the case right now. So what's coming from Mexico? Mostly, not all of them, but we get a lot of our vehicles from there. They manufacture there. As Ebony mentioned earlier, even in places where the cars are being assembled in the U.S., some of the parts are coming from Mexico. So guess what? If that door is 25% higher, then
the whole car.
Yeah, you got to pass that on. Trucks, computers, fruits and vegetables. These are some of the major imports we're getting from Mexico. Canada, we're getting things like crude oil, again, vehicles, machinery, plastics. There's 3-4 states, maybe more, that's actually getting utilities, electricity from Canada.
Interesting.
Yeah, very. So, and they've been very clear that they're going to put that. They retaliating with the same tariff, 25%. And some of this stuff is being walked back. Some of the individual products are saying, okay, we're going to delay the tariff on that, so it's getting really crazy. It literally is changing by the day, by the minute of what they're moving forward with, what they're rolling back, and it's just it's becoming very problematic to try to decipher this on a day-to-day basis and plot out. And I'm going to tell you in just a second how that plays into the stock market in just a second. So go ahead.
So what I want to bring up is that the stated idea is that bringing back products actually being made in the U.S.
Right.
But it's not a light switch.
No.
So if the tariffs switch on today or last Tuesday, that doesn't mean that at that same time, all of these companies magically pop up that can now manufacture or produce or assemble the things that we were getting from other countries. It needs to, if that's the goal, it needs to ramp up.
Exactly. And, we're part of a global economy now. Mm-hmm. And I don't think that'll ever go back the other way. Thinking that this is a time where we're going to manufacture 80, 90% of the stuff in the U.S. to be used by the U.S., it's just not there, man. Like you talk about the skill set got to be there, the resources got to be there, the raw material got to be there.
The climate, some of the fruits and vegetables.
Yeah, it's just we're part of a global economy. I can't see the wisdom in this move right here because ultimately we as the consumers, we're going to pay more to get the stuff that we've already been used to getting. That's the bottom line.
So to the question, the second part of the question is consumer prices. So you talked about that a little bit, and then also how these tariffs affect the stock market and investor confidence.
Well, anytime there's a rise in consumer prices without a ramp up in production or something like that, that doesn't spell good news for the stock market. Mm-hmm. So we're going to see. Well, you're already seeing it. You already saw it this week. A lot of and another thing to keep in mind too, the stock market does not like chaos. Mm-hmm. There's a level of built-in uncertainty already in the stock market. So the market's used to dealing with that. But when the market can't make out, when buyers and sellers can't really make out heads or tails of which way things are going overall, what typically people do is typically start to sell, which brings the market down. So that's why we saw a 600-point drop this week. We saw, I think, another day it might have been 700. It's some really big drops right there in a row. And that's exactly what happened. The market does not like the uncertainty. And I see that Sharonda, our good friend Sharonda Ryan, she shot us a question about maybe we could give some of the State of the Union highlights.
So first, I want to thank Sharonda for her question. And then second, I want to let you know that our goal today is to be as apolitical as possible. We are answering the questions that were asked. I will say, however, I did not watch the State of the Union. I tried to get some highlights and get to the meat of it through the various news channels, but it was really, really hard to get to that without all of the political bias. All
the political noise.
So you can't get what was actually said. You get everyone's opinion on what was actually said. So I don't have any highlights.
Yeah, I don't have any highlights either. I saw bits and pieces as I looked at the financial news. Of course, some of the political news spills over, but I did not watch it for my own reasons. But
and I guess technically it wasn't State of the Union; it was the address, the joint
session of Congress.
Joint session of Congress.
All right, so
yeah. So we had another question from Gracie Kemp. Hey, Gracie. So she wanted to know what to expect. Like, what does the rest of this year and the next couple of years look like?
Well, you know, I've been doing this long enough to know not to speculate definitely about the next few years as much as I would like to. I've even scaled it back to where I don't even speculate about the end of the year. I'm more concerned about quarter to quarter, next 3 months or so. So what can we expect over the next 3 months? I believe that, so let me say this first of all. Let me take a step back for a little bit. I know people are really scared. A lot of the calls that I've received this week, specifically as it relates to their investment accounts. I want to say this: the sky's not falling. Okay, there was some rocky turbulence this week in the stock market. However, we've seen turbulence before. I believe what got people, or why people are more afraid than normal is because of the political noise, not necessarily the financial noise. And when people become afraid, that fear just kind of sweeps over all aspects of their life. Because the political noise does affect, the market. It 100% does. But listen when I tell you, people, right now, as of today, the sky is not falling. So what about tomorrow? Well, I don't believe that anything that's about to happen that will send us, off the bridge in the next, quarter or whatever. But again, none of us have an 8 ball. We can't see what's, clearly what's coming. But I will say that, and I'm going to talk about a little later on, some things that you can be doing to shield yourself from what could be a significant downturn. But as it stands today, we okay. Even as a matter of fact, I'll say this, and I'm kind of jumping ahead a little bit. Even the other day when the market had that two big drops in a row, there were people who wanted to immediately take their money out of the market. But the very next day, we bounced back 600 of those points in the Dow. Okay. So some of this stuff is knee-jerk reaction. Some of it is, the market kind of throws temper tantrums from time to time. But again, this is not, we're not at a code red type situation just yet. And I'm hoping we don't get there. I probably shouldn't say just yet because I'm really hoping we don't get there. But you have to be very careful to take your emotions out of it as far as where the anger is coming from, or maybe even who you're actually mad at versus sometimes we extrapolate that across, well, I just, I want to take everything out. I don't like who's doing this, who's doing that. But it doesn't necessarily mean that we at a point where, things are just going haywire. We're not there.
And it's hard to separate your emotions from your money.
Yeah, it is.
It is. So if you feel uncertain in general, that translates to you feeling uncertain about various aspects of your life, from Absolutely. Your job to your money to your investments. It like you said, it goes across all of it.
Absolutely.
Okay, so since we're talking about the stock market and given the recent fluctuations, what are some strategies that you think individual investors can use to protect against the high volatility right now?
Well, let me say this before we go any further down that road right there. I am a licensed investment advisor. So because of that, I have to be very careful what I say to the general public. So I do want to say that anything I say today is not to be considered an offer to buy or sell any security. All right. Anything that happened in the past, there's no guarantee it's going to happen in the future. And all the disclosure that goes along with that, okay?
This is just general information.
General information, not to be specifically applied to your situation, all right? But I am going to give you some good info. All right, so I think the question was, what can people do to protect their portfolios? Well, it's going to kind of depend on where that money is, because if that money that you're talking about is inside a company retirement plan, there are some things you can do. You might retreat to, one of the fixed accounts. You might look at a money market inside the plan if it's available. And you can even do that outside of a retirement plan. You can do that inside of an individual portfolio. Now, in an individual account, there's going to be some more. You got way more options available to you.
So I do have a question about the company account. Like, who would do that? Would they have to initiate that themselves?
Yep, absolutely.
Okay,
Yeah, no one else can go in there and make those changes for you.
got it.
Yeah, no, and they're not going to do it. But so if it's an individual account that you're managing or your advisor is managing yourself, then you got some more options. Speaking of options, you can use a put option. A put option, I'm not going to go too heavy into what it does, but it will give you some downside protection, if you will. You might look at something like using trailing stops.
Okay.
That's a way that you can set a limit. Basically, a trailing stop will follow the stock up, and if it see a certain decline that you get to set, you can say, okay, I'm willing to take a 10% drop in this stock, and I want it to automatically sell. It'll do that automatically. You don't have to watch it. So there are things you can do, and if things get really bad, you can put what's called a bear market ETF in your account, and bear markets move opposite the market. So when the market's going down, a bear market fund will actually go up. So there's actually ways to make money when the stock market's going down. So again, that's why I say the sky's not falling, man. You just got to know how to make moves or have someone that know how to make those moves. But yeah, there's things that can be done to minimize the downside risk.
So I'm not an investment advisor, but I do have one tip, and that's turn the TV off.
Yeah.
You cannot be so emotionally involved in all of the volatility that it affects you.
Right.
So there are some things you just have to, it is what it is, and you got to keep pushing and keep moving and do the best you can, but you can't be so connected to it that it's giving you angst.
That's a great point, especially when you wrap this segment up. There's gonna, like Eb said, there's a certain amount of fear that's out there. And sometimes I really believe that that's by design. When people get scared, they give up rights.
They do.
When people get scared, they make bad moves. So keep your head about you. Keep your wits about you. Turn some of that stuff off. Turn some of it off. And, if you're a faith-based person, I would dig deeper over there right now. And now you got to be prudent. You got to make good decisions. But at the same time, do not inundate yourself with too much of that stuff, man. It's just not good.
It's not.
So let's take a break right here, and we'll get back in just a little bit. And we'll actually turn our attention to you, Eb. Some of the questions came in for tax season.
Okay, we'll be back in a minute.
And we are back. So, guys, if you missed us at the top of the podcast, what we stated there was that we had a special guest lined up for you guys this week. But when all the calls started to flood in and inundate our office, where people wanted to cipher through all the political noise, the financial news, stock market, all this stuff, we decided to put a pin in that, and we're gonna get back to that. But this week we wanted to just help answer questions that people had. So some of the questions that came in actually dealt with the tax side of things, and I stay in my lane. That is not my lane. So I'm going to kick those questions over to Eb. So, Eb, here's the first question I saw someone had asked. They said, what's the difference between tax planning and tax preparation? I know there's a difference there. What's that difference?
There's definitely a difference. So I want to explain it like this. Tax preparation is like taking 5 plus 5 equals 10.
Okay.
Tax planning is taking 5 plus 5 and figuring out how it can equal 12. Legally. I was
going to say, that doesn't sound too cool right there.
The thing with taxes is we are in 2025, but right now we are preparing taxes for 2024. So while there are some things that we can do to maximize your tax situation, we can't do as much as if we had started this process in 2024 because we can't go back in time.
I got you.
So that's the difference between planning and preparation.
Okay, so it sounds like tax planning is basically figuring out where I want these numbers to be next year.
And how to get there.
Whereas tax prep is where are they right now and what do I owe or what am I getting back?
Exactly. And it kind of just is what it is.
Is what it is. And I've seen you be stressed out when people want you to be able to kind of go back in time and do the planning in reverse.
I don't have a time machine.
Right. That just doesn't work well.
It doesn't.
I can understand
Especially when I told them,
what to
hey,
do.
yeah.
Right. So I don't know if you want to hit well, before we go there, let me ask you this. What are some of those changes that have taken place and I guess, break it down where we can understand it now, but what are some of some of the changes that have taken place that people are going to be seeing this year?
So since 2018, which is when they passed the new tax plan, there have been incremental changes each year.
Okay.
So those changes were designed for you to keep a little more money in your pocket. So some of those changes is an increase to the standard deduction. And I'll explain what the standard deduction is. So the IRS looks at your income and they designate a pocket of money that you don't have to pay taxes on.
All right.
And so that number in 2025 is higher than it was in 2024. So it was increased by anywhere from $400 to $800, depending on how you file. So if you are single and it's just you, it was increased to $15,000. If you're married, it was increased to $30,000. So again, what that means is you have your income, you subtract out the standard deduction of $30,000, and you're paying taxes on the rest.
Gotcha. Okay. What other changes?
So some other changes there are tax brackets. So your income determines what tax bracket you are in. The tax bracket, the threshold to get into the higher tax bracket has also gone up. So, for example, if you are married filing jointly, last year it took $201,000 to get into the 24% tax bracket. In 2025, it'll take $206,000 to get into that same bracket.
Okay.
So that's $5,000 that you're paying less on taxes this year than you were last year.
Okay. Go ahead.
And then for the highest tax bracket, right now the highest tax bracket is 37%. It takes $751,000 to get into that highest bracket.
How much again?
$751.
Okay.
Where it used to take $731.
Okay.
So that went up by $20,000.
So more income being taxed at lower levels then.
Right.
Versus okay. So you know what? I'm gonna tell you what that makes me think about. I was thinking this as you were giving that explanation. I guess one way that the government could lower taxes, but see, here's the thing: when you talk about lowering taxes, you're also talking about lowering the revenue for the country.
Right. That's one of the ways the country has revenue.
Probably the primary way. But what if you say, okay, we're going to lower the taxes to give, especially certain income levels a big break, but we still need the revenue. What if we impose a tariff that would disproportionately affect the lowest income people because they can least afford the increase in these products and services and things. And now, essentially, we got the whole nation financing a lower tax revenue. Just something I thought about.
Yeah. And I can't say that you're wrong.
Yeah, that's interesting.
So it definitely is interesting. Something else that I want you to be aware of is that, again, I mentioned we were under the 2018 tax plan. The thing about that tax plan is that it was not permanent.
Okay.
So, yes, it lowered your tax bracket. I mean, it basically lowered your taxes in various ways. It increased some things, like earned income credit has gone up this year. But those were all temporary because it has a sunset clause. And what that means is as of January 1st, 2026, all of the changes under the 2018 tax plan are going to go back to how they were prior. Gotcha. So right now, the highest tax bracket is 37%. January 1, 2026, it's going to go back to 39.7. Oh. And there are a host of other things that are going to go back to how they were. The interesting part is that the corporate tax rate was also changed, but that's permanent.
Oh. And right now the corporate tax is at 21%.
It's a flat 21%. So it used to be on a graduated scale like the individual tax rate. It went to a flat 21%, but that change was permanent when all of the individual changes that help put money back in the individual's pockets, those are all temporary and will go back to how it was.
Very interesting. So, Eb, let me ask you this right here.
Mm-hmm.
Because we've heard, I think if I got my number right, I think it was 7,000 people from the IRS that were let go. Mm-hmm. Will the expected staff cuts cause, are you all anticipating any delays on tax refunds because of that?
So most of the tax returns are processed electronically.
Okay.
So if you are a tax preparation company, accountant, and you do more than 100 returns in a season, you're required to send it in electronically. And it's just a whole bunch of computers that look at everything, and then they shoot you back out your refund eventually, or process your tax return eventually. Where it comes in is if there are any returns that need actual physical touch.
Gotcha.
So if there are, and certain returns have to be mailed in. So those, the processing time for those will definitely slow down. And then in addition to the 7,000 people already, there are plans to cut half the workforce. So about 90,000 people. That came out 2 days ago. So if that happens, then there will definitely be a delay in refund, in getting help, in processing, like if there's something fraudulent, in audits or examinations. All of that is going to be affected if the workforce is cut in half.
Oh my goodness, I can't begin to imagine what there's so many different ways that can go, but that's a scary proposition. How many people you said?
90,000.
Gee, yes.
According to Associated Press.
Wow. So here's a question I have. The question that came in.
Mm-hmm.
Do you tell us this? Give us like 2 or 3 things that people can do that will, help them get a bigger refund, or just what's some of the simple things that people may miss when they can get a big either owe less. So it's because some people are just interested in owing less.
Right.
That they can owe less or get a bigger refund. What's some of the simple things that people kind of miss or just overlook?
So some of the simple things are just making sure that you account for every dollar. So we talked about the standard deduction earlier. Sometimes there are things that you can deduct that sometimes people will just take the standard deduction without even looking at the itemized deductions. Mm-hmm. So those things are like medical expenses, property taxes, mortgage interest, charitable contributions. All of those things are what is considered itemized deduction. So if you have any of those things, you don't want to just choose standard because it's easiest, because you may get a bigger deduction by actually listing all of those things out. And some of the deductions that people miss are medical miles. So a lot of people don't know that you actually can deduct the miles that you drive going back and forth to the doctor. Doctor, physical therapy, things like that. Also charitable miles. So if you volunteer with an organization, you can deduct the amount of money that you give them. You can deduct any goods that you may donate, but you can also deduct the miles that you drive back and forth for volunteer purposes.
Now I got a question for you. I heard this years ago. I don't know if it's true or not. Can you deduct if you giving your donation at church, mm-hmm. Can you deduct the miles it takes to drive from your house to church, or is that pushing it?
That's pushing it.
Okay. I don't know, but still, well, maybe
are you volunteering at church?
All the time.
I know you are, but in general, if you're not volunteering at church, then no. If you're just
okay, so let's for real though. So let's say a person is volunteering.
If a person is
yes, parking lot or whatever it is they do.
If they're volunteering at church, yes. Yeah. But if they're just attending church, no.
That's very interesting.
Mm-hmm.
Very interesting.
And some things that you were talking about, things that you don't want to miss that can help put more money in your pocket or increase your refund or decrease the amount that you owe. But there are some things that work in the opposite way. So okay. I run into a lot of people that will take a retirement distribution throughout the year for various purposes. And it just does not dawn on them that that's going to create a tax document. So next year, when it's time for me to do their taxes, they don't give me that document.
Now, when that results in a failure to file income or something like that?
Yes.
Again, this ain't
so what happens is later on in the year, they get a letter saying, hey, you did not report this income.
Oh, yeah, failure to.
And they adjust your taxes. The thing is, if they're adjusting the taxes, who do you think they're going to benefit?
Themselves, no doubt about it.
So 9 times out of 10, when they adjust it, what you owe is higher than when you give me the document and we do an amendment.
Gotcha.
They're always going to err on their side, right, not on your side. So any document that comes, open it, for one.
Right.
Because you'd be surprised how many times I get documents that hadn't even been opened. But like, oh, this is your car insurance. I don't need this.
Yeah.
So first open it to make sure that you have all of your documents, and then just wait. Like, think about anything that you may have done throughout the year that may have even generated a tax document, and make sure you get it to us.
That makes sense. So here's a question that came in from Jermaine. It says, oh, I'm sorry, I probably shouldn't have said the name. Well, I know a lot of Jermaines. All right, so I know a lot of Jermaine. But it says, I'm about to receive a bonus at work and I don't want to be hit by taxes. What can I do?
All right. So it depends on what your goal is. When the IRS taxes your income, they don't care if your annual income was divided by 365 and you got a little bit of it each day, or if you got it all on December 31st. It's all your income, and that income will be taxed. So when you get a bonus, bonuses aren't taxed any differently than regular income. So if your goal is to bring home more,
okay,
then yes, you can adjust your withholdings so that less is withheld from that bonus. However, that doesn't mean that you're not going to owe that same amount at the end of the year. So they're either going to get it now or they're either going to get it later. But because it's a bonus, it's not taxed any differently than your regular income. On your W-2, all of it will be added together.
So what about when people, it was called
Go 99.
Yeah, talk to me about that. What happens with that?
When people go 99, they basically increase their exemptions to 99 so that no federal taxes are coming out. So when you look at your paycheck, it's 3 different taxes that come out. There's federal withholding, FICA, and Medicare. Federal withholding is the only one that actually goes to affect your taxes. Like, that's the only one that's going to affect whether you owe or get a refund. Okay. So people will go 99, so that number is 0. So that they can bring home more money at that particular time.
Gotcha.
Again, though, that doesn't mean that they're not going to owe whatever the taxes were for that bonus. They're just going to owe it on the back end.
Okay.
But where people run into problems is that they will adjust it for a bonus and forget to put it back.
Yep.
So they may get the bonus in April, adjust it, they don't put it back, and so from April through December, no taxes are being withheld. And then they're hit with a big tax bill this time next year.
I got you. So I got another question for you. I think we got time to get it in before the break. Mm-hmm. Give me your thoughts on, we got about a minute. Give me your thoughts on a parent got a child off to school. Mm-hmm. The parent's still paying all the expenses, but the child has a part-time job and they want to claim them. They want to file their own taxes this year. I've heard you talk about that.
So the answer is no. As long as if the parent is providing more than 50% of the support of that child, which in your scenario they are, because the kid is still in the parent's pockets. So as long as the kid is in the parent's pockets and in school, the parent can claim the kid. What the college students don't, so I know that they talk amongst themselves, and you can get the American Opportunity Credit, which is just a credit for having tuition. While the college student may get $1,000, it's gonna be $2,500 for the parents because the parents have more income.
Gotcha.
So in that scenario, the parents need to claim the child.
Gotcha. Okay. Well, thanks for the guys. Hey, look, we'll be right back after these short messages. And we're back again. We're now in this last segment here with, and I think this segment here, we're going to get to some of the personal financial questions, financial management questions that came in. One of the questions that came in, and Eb, I'm going to just kick it over to you.
Okay.
It says, someone asks, how are rising prices of essential goods such as bread, eggs, cheese, stuff like that? And actually, I got an answer prepared for this one, too. How is that affecting household budgets, and what are some of the measures people can take now to kind of help mitigate some of those?
So every time I turn on the TV, people are talking about the price of eggs.
Yep.
They're high. Restaurants are having to adjust. So it's prudent for us to adjust as well. So some of the practical tips that I can give you is when you think about planning out your meals, shop the sales. Instead of planning out your meals and then going to the grocery store, look at the sales paper because grocery store sales are in cycles. So build your meals around what's on sale that week. Because all grocery store or all items at a grocery store hit a rock bottom price. So if you're shopping when those particular items are rock bottom, some people call it stockpiling, then you are going to be able to stretch that dollar a little more. Another thing is look in your pantry and look in your freezer. If you're like me and like a lot of people that I know, I may not have taken anything out this morning to cook. So instead of getting home, unthawing, waiting on it to unthaw, I'll stop at the store on the way home and buy something that I already have in the freezer. So just do a little more pre-planning and build your meals around what you already have at home. So that's a way to make your dollar stretch a little more at the grocery store.
That makes sense. Now, one of the things I thought about when I first saw this question was one of the problems that I've seen people, and I have done this myself years ago, and that is waiting too long to make financial changes. Just being more conscious of where your money's going. You know, anything you track, you control. So if you're not tracking your money, now, today is a great time to start actually tracking your money. There's plenty of tools out there to help you do it, but you need to see exactly where your dollars are going. If your method of tracking your money is just to see, do I have any in the account left over toward the end of the month, then I can guarantee you if things get real tight, you're going to be in trouble. Definitely. All right? Because you need to track it in real time. You need to know where each dollar is going. And what you'll find every time people do this, you're going to find areas you're like, why am I? And I think I may have talked about this. I don't know if I talked about this on a podcast, but somewhere recently. I realized I've been paying for a gym membership to a gym I hadn't visited in I don't know how long.
Right.
And I did, and I've gotten rid of that. So just tracking every dollar, but you need to do it now before things get real tight. And we know, like I said, eggs and things like that are going up. But again, get a hold to. That's the part I want you to focus on. Is tracking your dollars, knowing exactly where they're going.
And watch for those things that creep up, like cable bills and cell phone bills.
Yep.
When you signed or agreed to go with whatever company 2 years ago, it was a certain rate. Now you look up and it'll almost be double and you don't think about it because you have it on automatic draft. Well, let's actually look at it and see. And you call them.
That's right.
Mm-hmm. So what about... we did get a question about refinancing your home.
Okay.
Is this a good time to do it or what?
Well, it depends on what your current interest rate is. What I usually suggest is strongly consider a refinance if it's at least 1 full percentage point lower than what your current interest rate is. Anything less than that, you may find it's not really worth it. Okay. And also, and let me say this is going to vary, and I've said it before, but this will vary depending on the person, their situation, yada, 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 yada. But in most circumstances, you probably should only refinance what is the outstanding balance, as opposed to what the house is worth at this point. If you keep refinancing the whole deal, you're not going to ever get it paid off.
So I've heard, when you talk about refinance, I've heard people say, well, I don't want to refinance even if I can get a lower interest rate because I only have 15 years left. So why do I want to turn that 15-year loan into a 30-year loan? Well,
again, it may depend on the situation. But if you refinance the outstanding balance, you still could just lower that portion of it. You follow what I'm saying?
Mm-hmm.
And depending on what you're going to do with the difference that you save, because now maybe you're going to, so let's say, for instance, if it was you were paying $1,500 a month, but now when you refinance, you're paying $1,000. Well, what are you going to do with that $500? That may help make a difference and make that refinance worth it.
Got it. We also had a question from Darius, and he wanted to know how the proposed tax cuts and infrastructure spending can influence economic growth and employment rates.
Well, I would say this. I don't think this is my professional opinion. I don't think it's going to influence it in a positive way.
Okay.
So follow the logic. The logic is if you cut taxes, mainly for the wealthiest individuals in the country, who typically their wealth is tied to a company or their stock or what have you, they will in turn take those tax savings and use it in their company for reinvestment, research and development, expansion, bringing on more people. In theory, it sounds like that, which should in turn make more people are working. Now more people are paying taxes, so that's going to increase the GDP, yada, 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 yada.
So it sounds like a whole lot of things have to go right and on plan for that to work out.
Well, it does. But we don't have to guess about that. History has already shown it doesn't work because people don't do that. That's not what they do with those tax savings. They pass those tax savings on to the shareholders in terms the way they do it is by doing buybacks. So they don't typically use those tax savings to build another plant.
And so before you go forward, what's a buyback? Explain that.
Oh, I'm sorry. That's when a corporation would buy its own shares off the open market, which causes the other outstanding shares to increase in value.
That makes sense.
Yeah, but it makes a lot of sense, and that's typically how they return those savings back to the shareholder. It's not in the form of build another plant and we're gonna come out with this new product
and employ all these people. That's
not how they work. So if you cut in taxes and you decrease in infrastructure spending, I'm almost sure it's going to slow economic growth down. And what I'm hoping does not happen is that it slows it down to the point we go into a recession. Recession been looming. People that called for a recession a year ago, 2 years ago, some say it was the recession that never was. I actually think we were going into a recession and we did not. However, I think the likelihood of going into a recession has increased based on some of the changes I've seen the government make here recently.
Got it. Okay. So I have another question.
Okay.
Changing subjects just a little bit. So what should people be doing about their debt right now?
Well, I'm going to tell you, I don't have to think about that one long. This is the time right now to pay down as much consumer debt as possible. And when I say consumer debt, I'm talking about debt that you incurred that doesn't have anything to do with investments. So if you got, you took out a mortgage for an investment property, that's not really what I'm speaking to right now. But your credit cards, personal loans, even your own vehicle, things like that, I would be aggressively paying these things off because if things do get lean, like the way we're going, during the lean times, your liabilities will eat you alive. So while you can, go ahead and aggressively start paying these things down. And you might do something like if you're able to take advantage of 0% transfers on credit cards, or you may use HELOCs to do some things. It's a lot of ways to get some stuff done. But at this time, just the simplest answer, I would be shedding as much debt as I possibly could right now.
Got it. Okay. That's definitely some good advice. And we want to make sure that we hit all of the questions from our listeners. So we do have another question, changing subjects, but this is from Curtis. And he wanted to know if my full-time employer offers a 457B and my part-time employer offers a 457B as well, is it possible or even legal to participate in both? And both plans happen to be with the same Provider, yes.
Yeah, absolutely, you can. There's no prohibition against that. You just cannot exceed the annual contribution limit, which I think is $23,500.
Okay.
So as long as you don't go over the annual contribution limit, they don't really have an issue with it coming in from more than one 457 plan. And I think that's the same. I'm about 90% sure that's the same before 401ks too.
So the talk of the town last week was the economic blackout. So on Friday, February 28th, it was supposed to be a complete blackout where we were not shopping at any retailers, major retailers. They wanted you to shop local. So do you think that's effective? What's your take on it?
Well, I actually dropped a video for those that follow me on social media. It's effective in that it's raising awareness that the consumers do have a certain level of power. Now, if you're talking about effectiveness in terms of hurting the establishment, then the answer is going to be no.
Okay. And why do you say that?
Well, because most people that I saw posting about this, they either shopped more the day before or said they were going to shop after the blackout was over. So a retailer just withholding those dollars for 24 hours, but then giving it to them at a later time, that doesn't really do much. Matter of fact, that doesn't do anything.
So essentially you're saying 20 plus 0 is 20 and 10 plus 10 is 20.
Exactly.
So it doesn't really matter when you bought the items from them, you still bought it.
Exactly. So one of the things I brought out on the video I did is that if we as consumers want to have a real impact, one, you have to redirect those dollars to another, shop local or another retailer that's not a major retailer. Mm-hmm. So it's not enough to withhold the dollars. You got to redirect them. That's one. Two, any potential major retailer that you're trying to make a point with, you got to withhold those dollars over a period of time. Mm-hmm. One of the things I suggested was maybe a rolling 90-day blackout of targeted retailers that you may want to make a statement towards.
I know we all work hard for our money, so I want to make sure that I'm supporting stores that support me and that my dollars are respected. So I don't like going anywhere where I feel like they don't want my money.
Oh, absolutely.
And I'm not going to give it to them. Well, so I'll find an alternative.
You better believe it. But yeah, and I believe from what I understand, there's future dates set with future, with
I did see
retailers.
That.
Yeah. So again, even when I look at the amount of time that some people are calling for, I still just don't think it's long enough to get the point across. I think you really got to go. See, the thing is, publicly traded companies report their earnings every quarter, every 3 months. Withhold those dollars for an entire quarter, and I guarantee you'll start to get their attention.
You will. And it's a step. It's a step to say, hey, we do have power. And I want you to treat me like I have power.
Absolutely.
So another question we have is with Social Security.
Okay.
In short, how do you think it's going? Like, is it sustainable? And do you think by the time we retire, will it even be, will we even still have Social Security?
No. No, I don't know. We may. But now this is not something new for me that I've just started talking about. I've been talking about this for over a decade, maybe longer than that. Mm-hmm. Anybody been in my seminars, my webinars, what have you, about 8 times out of 10, I've brought this subject up. So the issues that Social Security has precede this administration, okay? This administration didn't create these problems. Right. A lot of these problems have been there. Now, from what I'm reading and listening to, this administration is going to make are making, or maybe plan to make, some decisions that may speed this up. Mm-hmm. But Social Security has been in trouble for a long time. You can go right to their website, socialsecurity.gov, and you can see right on their website, they tell you the date that the trust fund is expected to be exhausted.
It's not too far in the future.
No, it's not far at all. So, yeah, Social Security is definitely in trouble. Medicare is definitely in trouble. Medicaid is in trouble. Medicaid is actually on the chopping block. So there's a lot of changes going on. And sometimes we fool ourselves into thinking what is always has been and always will be. Well, Social Security hadn't always been around. Mm-hmm. It started during FDR's time. Just because it's here now don't mean it's going to always be here. Now, most of us grew up thinking that the Department of Education has always been here.
Exactly.
No, it has not. And
now it's on the chopping block.
It's on the chopping block. So it's definitely a different time that we're in right now. And the main point I want the listeners to leave with today is that we really need to be making decisions to make yourself as self-reliant as you possibly can. We all have to depend on these institutions to a degree, but as much as you can be self-reliant, you need to be that, man, because as I hear people say, no one's coming to save us.
Control what you can control.
That's right. So we really hope this episode has been right on the money with what you need. But
yeah, I've enjoyed it.
I have too. But time has gotten away. So guys, if like Ebony mentioned earlier, if you have any questions that you want to hit us with, hey, feel free to go ahead and shoot them in. You can reach me at 901-209-4015, or you can find me on social media at the Money Jedi on Facebook. Actually, it's Reginald Clark / Money Jedi. I think that's what it is.
I think so.
Yeah, and on TikTok and Instagram, it's the THE Money Jedi. But again, 901-209-4015 is how you can get a hold of it.
And I'm at Eb the Advisor on social media channels, and that's EBTHEADVISOR, Eb the Advisor.
So, guys, we got to get out of here. As always, continue to plan, protect, and prosper.
See you next week.
It's time to elevate.